Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review for the week ending September 5th, 2025. So this week we'll spend some time discussing gold, thus the title of the review, All That Glitters. The price of gold made a new all-time high during the week. We're starting to see some positive momentum and a breakout of the price from the trading range that we've been seeing since the month of April. There's multiple reasons for that, but I think it ties pretty much nicely with the macro and market backdrop, which is of course characterized by uncertainty on trade, loss of confidence in the US as a business partner, potential loss of independence of the Fed, and the job market, which is weakening, Fed cuts coming. So all of these tie well together with this trade. But before we're going to go, let's look at this week's markets that close on Thursday. So positive return for bonds. Interest rates are a bit lower as the markets are pricing in with more conviction, let's say a steeper path of cuts from the Federal Reserve. The TSX, S&P 500, NASDAQ, when you bring everything back in Canadian dollars, pretty much neck and neck for TSX and S&P 500, a bit better for NASDAQ. EFI was a bit lower on the week. Emerging markets are up. Price of oil was down. The Canadian dollar was down on the week all the way to Thursday, but this morning we had the jobs reports, which were negative on both sides of the border. Well, I'll say disappointing, positive in the US, very negative in Canada. Canadian dollar is outperforming the USD today, so the picture might be a bit more mixed or even positive by the end of the week. Let's see. And the price of gold up 2.8% on the week. Over the last 2 weeks, it's between 5 and 10% depending on your starting point. So we're seeing an impulse from the price of gold, and this is where the focus will be here. So if we go to the next slide here, so here you have the data since early 2020. If you remember, in the summer of 2020, the price of gold broke through $2,000, and the nightly news were often during that span opening discussing the price of gold. And after that, you had a period of consolidation that lasted for about 3 years. That brought us to 2024, when, after all of the rate hikes that we had seen from the Fed, from the Bank of Canada, from the ECB to fight inflation, then it became pretty obvious that the next moves would be rate cuts. So of course, markets are always pricing those things ahead. So in 2024, price of gold was a big driver of market action. We were positioned for that. We benefited from that trade. We exited somewhere in the fall of 2024, early 2025, as markets were and trying to price in the effects of the trade policy from Donald Trump, especially the inflationary impact of tariffs. Well, you had another push in the price of gold, but since April it had been a consolidation in a trading range. So a few weeks back we re-entered into the position on gold. We thought, all right, so the consolidation is going on. It's time to start building a position for what we thought would be an eventual breakout, and we seem to be in the breakout now. Let's be conscious that markets can be volatile, and that could be a head fake here. But the best trades are usually those that have many things going for them. So on the right, just maybe a few reasons why we think gold is still a buy despite it being at the price being at all-time highs. Well, first and foremost, it's central bank demand. The fact that the U.S. is losing its luster as an important trade partner for many countries, and the fact that it can use its dominance in currencies to impose sanctions to countries like Russia, for example. But if you're China, if you're the countries that are aligned with China and India, you might think that, well, divesting away from the USD in the reserves that are kept at the central bank might be a good idea. And we've been seeing that over the last few quarters, or maybe even many quarters, that the USD is losing some of its leading position. It's still the leading currency, but it's not another currency that is used to replace the USD in central bank reserves. It's gold. And just some interesting data here. Remember that gold is accumulated, it's not consumed. There's this saying in commodities, that the cure for high prices is high prices. For example, if at some point we have not enough oil going around, there's too much demand for oil, and prices are skyrocketing. Of course, new production will come in to flood the markets and to stabilize the prices. For the price of gold, that's not how it works, because historically, the data that I have is that historically there's been about 220,000 tons of gold that have been extracted in the history of humanity. Most of this gold is still around. About half of that is in jewels. The rest is mostly in financial markets and central bank reserves and the likes. And annual production of gold around the world is about 3,000 tons-ish. So that means that every single year, the supply of gold rises by about 1 to 1.5%. And that's it. If central banks say we want more and more and more gold in our reserves, then the price of gold will go up and up and up. And there's the notion of a fair value, fair price of gold is pretty elusive. It's different than other commodities. So central banks having a higher demand for gold, this is a factor that is at play here and could continue to be at play and support gold prices going forward. Geopolitical uncertainty means that in your portfolio, gold can play a very important role. When there's some uncertainty, it acts as a safe haven and it can counteract negative moves on equities, for example. If there's too much inflation, well, gold usually does well, fixed income does less well. So when you have all of this kind of uncertainty, gold plays an important role in portfolio. So there's more demand from investors like us to add gold into a portfolio, thus pushing the prices higher. Real interest rates and monetary policy. So usually when real rates fall, this is positive for the price of gold. So real rates are the nominal rates that you see on the screen minus inflation. So how the interest rate that is left in your pocket when you compensate for the cost of living. And there's a good reason, because there's an alternative to gold, which can be fixed income. And if fixed income is less interesting on the real rate of return that you get, well, that usually bids up the value of gold, because gold doesn't pay a dividend. So when real rates are elevated, there's usually less demand for gold, and when real rates are lower, there's more demand for gold. So there's that. And with the Fed here on the brink of multiple rate cuts, that supports the price of gold. Fiscal expansion, debt sustainability. If there's doubts floating around about the sustainability of debt in certain countries and the fiscal situation in many countries, then less demand for fixed income, more demand for gold. De-dollarization trends. So the fact that central banks and also investors are leaving the USD, let's say, behind, or it's a trend. We've seen a weaker USD. Well, weaker USD usually leads to higher price of gold, because the USD and gold can be seen as alternatives. And again, as I mentioned, limited supply growth, which is a big factor here. So it's not about cherry picking here. It's usually those are the main drivers of the price of gold, and we're at an interesting juncture where all of those factors have a role to play here. So since 2023, the price of gold has pretty much doubled. What's the next level? What's the next step? We don't know. We don't set price targets. This week we've heard the likes of Goldman Sachs saying that, well, now we have a target of $5,000 on the price of gold. When is that? I know that before we go to 5,000, we need to cross 4,000. So we'll see how that goes, but we still think that it's an interesting asset class to hold. We don't have a specific price target here, but we do know that we have a solid conviction that this will add value to our portfolios and to our clients. So we're holding it as a discretionary position in all of the mandates where we can put it that are managed by the asset allocation team. So very important theme here. So I wanted to get that out of the way. Now, maybe getting back to the macro data of the day. We've had the jobs reports in Canada, in the US. Let's start with the US on the left. 22,000 jobs were added. That's weak. The estimate of the number of jobs that need to be created every single month to keep the unemployment rate flat is about 50,000. This is weaker than in the past because of the migration policies in the US and all of this, but it's a weak report. And remember that last month, The president didn't like the data that he had, fired the BLS head, and now we have another report. People were wondering, right, well, with reason, are we going to see like a blowout number and think, all right, this is the data has been tempered with, let's say, for political reasons? Well, it doesn't seem like it because it's a weak number, and the revisions to the last 2 months were negative. So it seems like a legit number that we have here. The number of hours worked per week were down a little bit as well. So there's been this accumulation of negative news for the U.S. labor market. This week we also had the reading of the Beige Book, which is the survey, the economic surveys that are done by all 12 regional offices of the Federal Reserve. And what we've seen is that growth is flat to modest, negative in some counties, in some districts rather. Employment, the same thing. We're seeing a loss of purchasing power because wages are not keeping up with inflation. So you have a report that is smelling very much like stagflation, and this is what we have here as well, a slowdown in the labor market. So the Fed was talking about measures of slack in the labor market as a guide. Well, we have impulse slack now. So it's pretty much a shoe-in that we have a rate cut on September 17 by the Fed. After that, it's the speed at which it will go. This week, we have the hearing of Stephen Myron, the nominee by President Trump to replace Mrs. Kugler's place to take the role that Ms. Kugler left recently at the Fed to serve as a governor and have a vote for the next decision on September 17. So we'll see what kind of impact that has on the messaging. And it's fair to expect maybe Mr. Myron will be a dissenter because he will want to have more than 25 basis points of cuts, maybe 50 or 75 basis points. So we'll have lots of stories to tell about the Fed soon, but the macro data now is starting to confirm that it's time to cut in September. There's little doubt about that. For the Bank of Canada, well, on the right, the labor market, minus 65,000. If there's that's a very bad number. Let's just put this out of the way. The average over the first 6 months of the year is minus 6,000. So that's a bad start to a year. Of course, there's many stories here, but maybe one silver lining is that this is mostly part-time work, so usually those can reverse more quickly, and also it's self-employed, and so there's no reasons to cheer when there's fewer self-employed Canadians, but this is a category that tends to be quite volatile, and you can have massive turnarounds from month to month. So maybe it's a fluke, maybe we'll have a sharp reversal, we don't know, but the quality, let's say, of this report seems to be not as solid as if it was, mostly full-time workers that had lost their jobs. So now, of course, this begs the question, and we can go to the next slide here. What's next for monetary policy? As I said, for the Fed on the left, a cut in September. Now it's even it's warranted to wonder if there's going to be a cut of more than 25 basis points. We'll see, but after that, for October, for December, for January, for March, as you can see, it's pretty much a cut. One more cut at each decision. So the question now is the pace of these cuts, not whether they will cut in September. So for now, the market is getting to pricing that quite aggressively. USD down, gold up, rates are down. Stock market seems to like it for the moment. We'll see if you have less if you have lower rates, but the economy that's not doing too bad, that can be good news for the stock market. So it's going to have some important implications for for financial markets. We'll keep you posted as we evolve here. But on the right, for the Bank of Canada, markets are pricing in 72% odds of a cut in September. We don't think the odds are zero, but this is not our base case. We think the base case would be for them to hold still in September, mostly because of the recent data that we've had on consumption spending, final domestic demand. We discussed that last week. We think that the bank has done its job. We are still open, and we think that it's likely that the bank will cut maybe one more time by the end of the year, maybe two, but I don't think that there's a rush to do it in September. Maybe can gather some more data and go within October and December. We'll see how they decide to go with that. But after that, as you can see, the bank is pretty much done or close to being done with its rate cut path. for the Fed. There's lots of work to be done. So again, this supports an outperformance of the CAD versus the USD. So many important implications here. Now, next week, we'll have some very important data as well. Not in Canada, we only have building permits here, but in the US, of course, today it was the labor market, but next week we have inflation data, which is very important. We have the PPI inflation, so producer price index inflation. The last month was pretty strong, so producers are paying much more because of the tariffs. And after that, the question is, how long before they pass the bill to consumers? So that brings us to the CPI inflation numbers. Next week, what's expected for August, slight acceleration, but this will also be a very important picture because if you have weak job market, but you have hot inflation, that kind of makes the job of the Fed complicated. Although it seems now that the Fed is focusing more on the labor market. Market is pricing many cuts as well here. So we'll see what they do, but I think it's fair to expect the Fed to accelerate the rate cuts now. But one wild card could be if inflation picks up rapidly, that could lead to some fragmented views, some fragmented consensus in the markets. All right, so that wraps it up for the week. It's always a pleasure to serve you. If you appreciate the content here, please share, and of course, come back again next week.